Today we are getting into a set of rules that really change the game for banks, for investors, honestly for any company that deals with money. It's called IFRS 9. Now I know it sounds like just another boring accounting standard, but trust me, this one is different. It was pretty much born out of the 2008 financial crisis to make sure we could all see trouble coming before it hits. So let's break down how it all works.
Okay, so to really get IFRS 9, you have to see how it was built. This thing didn't just appear overnight. Nope, it was a really careful piece-by-piece project that was rolled out over about 5 years. You can see on the timeline here, they started with the basics, right? How to classify assets, that was back in 2009. Then they layered on rules for liabilities, then the tricky world of hedge accounting, and finally, in 2014, they dropped the real game changer, the new impairment model.
So, to make sense of all this, here's our roadmap. We're going to break it down into 4 parts. First up, why we even needed a new rulebook in the first place. Then, we'll get into the nitty-gritty of sorting and valuing these financial instruments. Part 3, this is the big one, is all about predicting future losses. And we'll wrap it all up by looking at how the standard deals with managing risk.
All right, let's kick off with Section 1, a new financial rulebook. Why bother changing everything? Well, the whole point was to move away from this tangled web of complex rules and get to a place with clearer, more straightforward principles. Let's see what that actually looks like. This slide really shows you the before and after picture, and it's a big deal. The old system, IAS 39, was, well, it was a mess. But its biggest problem was its whole philosophy. It ran on what's called an incurred loss model. Think of it this way. You could only report a hole in the ship after the water was already gushing in. IFRS 9 completely flips that script. It's all about an expected loss model, which forces companies to look ahead, to see the icebergs on the horizon, and account for them now.
Okay, let's move on to our second section, where we get into the nuts and bolts of sorting and valuing these instruments. This is the first major pillar of the whole standard. So how does IFRS 9 take this huge universe of different financial products and actually make sense of them? Well, it all starts with a surprisingly simple 2-step process.
So how exactly does it classify a financial asset? It takes all that complexity and just boils it down to 2 fundamental questions. Seriously, the answers to these 2 questions pretty much determine everything else that happens.
And here they are, those 2 key tests. First, on the left, you've got the business model test. It's simple, really. What's your plan for this asset? Are you just holding it to collect the payments, or are you maybe thinking about selling it? Then, the second test, over on the right, is all about the cash flow itself, the FVPL test. It's asking, are the payments you're getting just the principal and interest, like a plain vanilla loan, or is it something a little more complicated?
The answers to those 2 tests lead you straight to this table. Every single asset ends up in one of 3 buckets. So if your business model is to hold to collect, and it's a simple loan, it gets measured at amortized cost. Think of this as its original value, just adjusted over time. Now, if your plan is to both hold it and sell it, it gets measured at fair value through OCI. This means its market value is tracked, but those changes are kept kind of separate from your main income statement. And finally, if you're just trading the asset or it's a really complex instrument, it goes into the last bucket, fair value through profit or loss. Here, every single tick up or down in its value hits your bottom line immediately.
Now for the second pillar, and honestly, this is the big one, predicting future losses. This wasn't just some small adjustment. This was a complete revolution in accounting. It came directly from the financial crisis, where we saw banks recognizing massive losses way too little and way, way too late.
I love this quote on the slide, because it just says it all, doesn't it? The old way was like waiting until the rain was pouring down to finally report that, hey, things are getting wet. IFRS 9 makes companies look at the weather forecast, see those storm clouds gathering, and estimate how much rain they expect is going to fall.
And the tool for doing this forecasting is something called the expected credit loss, or ECL. The really important thing to get here is that it's not just some wild guess. It's a calculated probability-weighted estimate. You have to think about a range of different future scenarios, good, bad, and somewhere in between, and use all the forward-looking info you have to come up with a realistic estimate of those potential losses.
So here's how that works in practice. It's this 3-stage model. Over on the left, in stage 1, you have all your healthy assets. The credit risk is low, everything's fine. For these, you only need to account for losses you might see over the next 12 months. But if the credit risk suddenly increases in a big way, maybe the borrower gets into some trouble, that asset moves to the middle, to stage 2. Now the alarm bells are ringing, and you have to recognize all lifetime expected losses. Finally, on the right, You've got stage 3. This is for assets that are officially credit impaired. You know, the borrower has defaulted. You're still recognizing lifetime losses, but the accounting gets even more serious.
And that brings us to our final section, where we'll look at two key practical parts of the standard: how IFRS 9 deals with managing risk, and the rules for when an asset or liability is officially taken off the company's books.
First up is hedge accounting. This is a technique companies use to protect themselves from risks, like, say, a sudden spike in interest rates. The really big change with IFRS 9 was to make these accounting rules much more flexible, so that what you see in a company's financial statements actually reflects what they're doing in the real world to manage their risk.
Next up is derecognition. It sounds super technical, I know, but it's actually pretty simple. It's just the set of rules that decides the exact moment when something isn't yours anymore, and you can officially remove it from your balance sheet.
So when is something officially off your books? Well, it basically boils down to a couple of things. Either your contractual right to get cash from that asset has expired, or you've sold it and you've transferred pretty much all the risk and reward to somebody else. If you sell a portfolio of loans and you're no longer on the hook if they go bad, well, they're not your asset anymore.
As we wrap up this explainer, I just want to leave you with this one last thought. IFRS 9 is so much more than just a set of accounting rules. By forcing everyone to take a forward-looking perspective on risk, it has the power to change behavior itself. It encourages a much more proactive, a more careful approach to lending and managing risk, and that, in turn, could lead to a more stable global financial system. And that, well, that's a change that affects every single one of us.